Good afternoon, everyone, and good morning to those of you on the West Coast. This is Joshua Lee, and on behalf of the Public Contracting Institute, I'd like to welcome you all to today's GovCon 101, covering accounting essentials, joined by our expert instructor, Bill Walter of Forbes Mazars. Before we jump in, I do have some housekeeping announcements and reminders for those of you seeking credit. Please make sure you guys are tuned in. We will not be providing passwords for this GovCon 101 session, but there will be a few polling questions at the conclusion that you will need to complete if you are seeking credit. Your participation is important, so make sure you stay tuned in for those polling questions at the end. If you have any questions or comments, you can submit through the questions panel that is at the top right of your GoToWebinar window. You can submit any comments, questions, and anything you'd like to communicate to Bill through the questions panel. With that, I'm going to ask everyone to send a hello through the questions panel. Let us know what you say. Thank you so much for joining, and I will hand it to Bill.
All right. Thank you, Josh. And happy to meet everybody today, at least virtually. You can see me, but I can't see you. And hello, Ashley. Nice to hear from you. And so today we're continuing our discussion of the basics of government contracting and GovCon 101. Today we're going to be talking about accounting essentials. So we have accounting requirements. We have a little bit about internal controls. We have system expectations that come along with having government contracts. And so with that, let me introduce myself. My name is Bill Walter. If you've been with the series this year and last year, you may have been in one of my other sessions where we talk about other GovCon 101 elements. I'm a managing director here at the accounting firm Forbes Mazars. We're a large firm. You probably haven't heard the name before unless you've been in one of these sessions, but we are one of the top 10 accounting firms in the United States and internationally. We have 8,000 people across the U.S. in many different offices. My group in particular deals with government contracting companies that buy and sell or sell to the federal government, either services or products. And so when you do sell to the federal government, there are some elements that come to mind. A lot of people will reach out to my team and say, hey, we're getting into government contracting the first time. I hear that there's some kind of unique government contracting rules and regulations we need to be aware of. Can you help us out? And fortunately, that's all my team does. We focus on 48 Code of Federal Regulations, which is the federal acquisition regulation. For those of you who are getting in for the first time, you may have heard rumors, and even if you've been around for a while, you may have heard that the government is updating the FAR. It first came out in 1984, April 1st, April Fool's Day, kind of a nice little present. But this year, the government identified the executive order. The president issued an executive order and said, hey, these rules have been around for 40 years in the FAR. It's the anniversary. And, it just keeps getting bigger and bigger and bigger each year. And we need to find ways to streamline it. One of the biggest complaints that the government hears is that people who want to sell to the federal government find it very difficult because they have to get through this bureaucracy. And several things come into those discussions. They've specifically identified the Truth in Negotiations Act, the cost accounting standards, and we're going to be talking about those today and how those have an impact because those are associated with cost reimbursement type contracts. So by the end of today, about 1:05-ish Eastern time, 2:05-ish Eastern time, we're going to start going into the question and answer phase. And we're going to have 4 questions about the topics we're going to be talking about today. And if you take a look here, you see we have 4 topics. So I'll give you a hint. We may have 1 question for each one of the topics. So hopefully by the end of today, you'll have a high level understanding of when accounting requirements are necessary under a contract. And that's very important. That's where I'm going to be spending the first part of our session today, is not every contract requires detailed accounting systems and accounting requirements and system approvals and things like that. In fact, a very small percentage of government contracts require that. But when they do, it's important to understand what contracts do and what contracts don't. require accounting system details. Um, for those, that small percentage that do require accounting systems, we're going to talk about what those requirements are. So we're going to talk about where in the FAR you can find them and what they are basically looking for. And then one of the biggest elements is cost principles. You may have heard terms like cost allowability. And the auditors want to make sure you're allocating that properly. Earlier today, I had a phone call with a client regarding the fact that their auditors were coming in and saying, you've got these other costs that you're allocating. We may need to have you update your disclosure statement to address those correctly. Okay, and that brings in the last topic we're going to talk about, which is the cost accounting standards, also known as the CAS. And we'll talk about some of the changes that are likely to be coming downstream with the CAS. I was at a meeting earlier this week or last week with one of the members of the Cost Accounting Standards Board, and he was telling all of us in the audience some of the things that the CAS board is considering to make it so that a lot of the thresholds are going to be increasing, very likely. If you're looking at cost accounting standards, you're a small business, it may be a little bit farther in the future than you were thinking, which is good news for many companies because the standards themselves are not a problem. The problem is how they get evaluated, overseen, and that causes quite a few problems. So today we're going to be talking about these 4 things on accounting essentials in GovCon 101. So the first question, when are accounting requirements necessary? And the corollary, when accounting requirements are not necessary. I think it's very important for people to understand both sides of the equation. If you're not sure after we're done, I would err on the side of making sure that you have an accounting system with the proper cost accounting elements into it. Because eventually, if you get into government contracting, I've seen this oftentimes, people get in, they put their foot in, they do a little bit of competitive fixed price work, then eventually they get into some non-competitive work, or they get into cost reimbursement contracting. And those are the areas where you see these requirements step in and take a lot of weight. Okay, so the GovCon marketplace, it's an interesting area. Within the GovCon marketplace, there really is no NAICS code, North American Industrial Classification System code for a government contractor, because the government buys almost everything. They buy military equipment, they buy construction services, they buy highway maintenance equipment, they lease buildings, they buy livestock, they do research, the government buys everything from bombs to brooms, as one of my fellow coworkers used to say. And in doing that, a NAICS code, you can't go in and do a search to say, ooh, that's a government contractor, because it may be a construction company that's doing that work. It may be a manufacturer. It could be a service provider. It could be an IT value-added reseller. All of these companies can be government contractors because they all sell goods and services to the federal government. Uncle Sam will buy it from commercial companies that are not for profit. That's what we hear about most of the time, because commercial companies have they've got very detailed cost principles that they have to follow. We'll talk about them when we get to the FAR. But these commercial or for-profit companies get a lot of oversight because they have a profit motivator. They are in business to make money. So a lot of the rules that we see that are in place because the government wants to make sure that companies who don't have competitive forces in place aren't selling to the government and making excessive profits. So commercial companies sell to the federal government. Not-for-profit enterprises sell to the federal government. The federal government also gives these not-for-profits grants, and they say, here's money in a cause that you're pretty well positioned on, and we'd like you to divvy up the money, but follow the rules that we have over here with grants. And we'll talk about those cost principles in a little bit. If you take a look at the top 100 companies that sell to the Department of Defense, you're going to see about a dozen colleges and universities in that list. So colleges and universities sell a lot of research and development to the federal government. And then finally, you're going to see state and local governments, a lot of highway projects, a lot of other areas where the federal government has provided some funding and insight, is found with government contractors. So each one of these, it's not a simple, these are government contractors. You take a look at this list, this covers the broad spectrum, and every state in the union is covered, and a lot of international companies also, and governments want to sell to the government. So the key message when we're trying to figure out, do I need these accounting requirements or don't I, is going to be based on the type of procurement method that's being used. So if you have a price-based contract, meaning that when I'm selling to the federal government, I give them my price. That's it. I don't tell them what my cost is. I don't tell them my profit rates, but I give them my price. And oftentimes competition is involved. So if I'm selling a commercial item and the general public will buy it for 50 bucks a unit, the government says, hey, we'll pay 50 bucks a unit as well. If it's a competitive bid and one company bid 60 and another one bid 50, the government can award to either the 60 or the 50 based on the value analysis that they do, but they're only going to take a look at the price. They're not going to take a look at how much profit they're making, et cetera. So when they do that, it's a price-based method, and the ones on the left-hand side here are not going to be generally having requirements for detailed cost accounting systems. If you're buying off of the federal supply schedules, and with some of the executive orders that are coming in today, over the past 20 years, I guess, the federal government has found more and more agencies issuing their own schedule type contracts, which is basically a price list where any government agency can buy off of your price list. The government came in, the current administration said, wait a minute, we've got all of these different agencies trying to bring commercial items in through the marketplace to sell them to all the government agencies, and that's why we have the GSA. So one of the executive orders that came out earlier this year was, hey, wait a minute, all you agencies that are doing all of this buying and selling of equipment and services on your own schedules, if it's for a common item that more than one agency can buy, we're going to start pushing that through the GSA. So expect to see a shift towards more of a use of federal supply schedules through the GSA over the next few months. The executive order came out with a 90-day window, 30 days you have to do this, 60 days you have to do this, 90 days you have to do this. And that's a notice to the heads of the agencies to tell the Office of Federal Procurement Policy, how are we going to make this happen to where we can transition from all of our contracts to the GSA. And so that information should have been into the government. We haven't seen how it's being cogitated yet. But on the left-hand side here, the price-based acquisitions, we're going to start to see some changes take place there. Not from a cost perspective, though. If it's not on a schedule, if it's not commercial, and if it's not competitive, the government still has to determine that the price is fair and reasonable, but they don't have those market benchmarks to work with, commercial pricing or competitive bids. So if it's a sole source procurement, if there's a change order to a contract that may have been competitively bid, well, it's now going to be no longer competitive. So the government's going to need tools to figure out what that price, how to determine if that price is fair and reasonable. And once you get into the cost-based world, that's where all of these accounting requirements come in. So if you're working on competitive bids and that's all you're going to work on is competitive bids, or if you're working off of a schedule, chances are you don't need to worry at all about costs and cost type contracting. So I put this little chart together. Green is good. Red is, okay, we got to start paying attention. So for commercial contracts, the commercial contracting rules are spelled out in FAR Part 12. Simplified acquisition procedures are spelled out in FAR Part 13. Those are generally low dollar value contracts. Sealed bid contracts are fixed price, competitive. It's the ultimate form of competition. Those are spelled out in FAR Part 14. Negotiated competitive contracts are spelled out in FAR Part 15. Negotiated where the price is set by law or regulation are also spelled out in FAR Part 15. So each one of these contract types, and this is where the preponderance of the contract awards are made through one of these 5 contracting methods. You see, we got a lot of green X's under market-based price, competitive price. Those are the ones where you are going to find most of the time cost will not be an issue. And if you're doing nothing but selling in those areas, you probably don't have to have the detailed timekeeping system and all the rest of the stuff we're going to be talking about for the rest of today's session. However, there are some cases under commercial and simplified acquisition procedures where you see my red question marks. That's a little warning that says, hey, there are some things that certain contracting officers are doing. So, for example, you may have a competitive commercial item contract where you know you're competing against somebody, and it may be less than $2 million, which is the threshold for where a lot of more onerous rules come into play. And in that case, that contracting officer may say, hey, I still need to get some extra support here to make sure my price is fair and reasonable. So they may ask for cost or pricing data. And if they ask for cost data, and if you provide cost data, well, the government has to analyze that cost data. They have to use cost analysis. So there are some cases where commercial item and small dollar value simplified procurements may have to worry about cost and cost accounting. And during negotiations and cost and price analysis classes, we get into that with a lot more detail. But in most cases, with those top 5 contract methods, you're going to find that cost and cost accounting will not be an issue. But when we get into negotiated non-competitive contracts that are greater or less than $2 million or greater than $2 million, chances are the contracting officer is going to ask for cost or pricing data. They're going to ask for things like FAR Table 15-2. They're going to ask for certifications. All of those things are indications that you need to have an accounting system that's in place. So pricing methods is one of the 2 things you need to be aware of. And the second is the type of contract. So if you have a fixed price type of contract, and if it fits in one of those top 5 categories, you have a pretty minimal chance of needing an accounting system unless you plan through a strategy to get into some of the more non-competitive or the cost reimbursement type contracts. So cost accounting requirements only apply to fixed price contracts if cost analysis is performed to determine that the price is fair and reasonable. So if your CO says, hey, I need cost or pricing data, whether they ask you to certify it or not, they have to do cost analysis. The regulation says don't ask for cost data unless you're going to do cost analysis. So if they ask for it, and if they don't do cost analysis, that puts the contractor in jeopardy of having potential issues downstream with their accounting system. If you have a fixed price contract that does have a contract clause that may require the determination or the negotiation of cost, okay, so if you have a changes clause to a contract, if you have progress payments for a fixed price type contract, if you have a contract that's called a fixed price redeterminable type contract, or if you have a fixed price incentive fee type contract, those require a greater detail look at cost. So in some cases, fixed price contracts may have a requirement to do all the cost analysis. Cost reimbursement contracts, hey, they got it. If you have a cost reimbursement contract, before that can be awarded, you have to demonstrate, the contracting officer has to confirm that your system is capable of accounting for costs in accordance with FAR Part 31, which we're going to jump into in just a minute. Time and materials contracts, the T in time, it's a fixed price rate. So you don't need to track your costs. How much did I pay my employees? How much did I not pay my employees? You don't have to track your indirects, et cetera, for time. You've agreed to the government that your price per hour is X. And if your cost performance is higher, you lose money. If your cost performance is lower, you make money. But there's no requirement for the T portion that you track your costs at that level of detail. Now, if you have materials, the materials costs are generally going to be requiring an accounting system because you have to make sure that the materials that you're billing, the price is fair and reasonable, and you also have to make sure that the costs are allowable. So there will be some requirements that come in. So 2 different things to consider. Number 1 is the contracting method. And if you're in the top 5 of this list, chances are you won't have to worry about a contract and your accounting system unless it's a cost type contract. If it's a cost type contract, then FAR Part 31 applies. And if it's a T&M, the materials portion could pull you in. So it's important to understand those elements of the contract. And some of the clauses that you need to be aware of, this is not all of them, this is just a list that I came up with. The biggest is 52216-7, which is allowable cost and payment. This particular clause comes into play anytime you have a cost reimbursement contract. And this clause says, hey, you're allowed to bill the government for allowable costs in accordance with FAR Part 31. So if you have a cost reimbursement type contract, you have this clause in your contract, and it says your accounting system requirements are in play the whole time. The other set of clauses that I've bolded here is the 52-230 clauses, and these are the cost accounting standards clauses. There are 7 of them. And those clauses, basically, if you sign up to the CAS, you're signing up to make sure that you can do your cost accounting on a consistent basis with all of your contracts that are subject to those requirements. So if you have those 2 clauses in your contract, A, make sure it's a cost reimbursement contract, and B, make sure you're actually subject to the CAS. We're going to close off today's session by talking about the cost accounting standards and when they're applicable and when they're not. And if they're not applicable, get those clauses out of your contract. If the prime is flowing them down to you, saying that, hey, as a sub, you have to follow the clauses that are in our prime contract, take a gander through them and look and see if these clauses are in there. And if they are, make sure you understand when they apply and when they don't. And if they don't apply to your contract, get them out of there. So if you have a fixed price competitive subcontract, you should not have an allowable cost and payment clause in your contract. If you're a small business, you shouldn't have the cost accounting standards clauses in there. A lot of people get concerned because they have these 52-215 clauses in there that deal with FAR Part 15, contracting by negotiation. And those oftentimes you have to leave in there unless it's a commercial item contract. So if they throw these clauses in there that says that, hey, we've awarded you a contract that may be exempt from TINA, but you may have modifications that could be subject to the Truth in Negotiations Act. Okay. As we go down, if you have a fixed price contract and you want to get interim financing through the use of progress payments at 52232-16, there are requirements in there that you track costs and you only can include in your request for payment for progress payment allowable costs. So it kind of brings that in. If you have changes in your contract and it's not a commercial item contract, the 52-243 clauses will apply, and they say you're entitled to a change if your costs have increased in the contract. So when you take a look at that, once again, cost can become an issue. But there are a lot of times when you're dealing with commercial item contracts that they don't have a separate termination clause in 52-242. They don't have a separate contract financing clause in 52-232 because all of their clauses are going to be under 52-212 clauses. So 52-212-4 is the terms and conditions for cost reimbursement contracts. I think I have that right. It could be -5, but I think it's -4. And within that is all of the requirements and all of the clauses for termination, for convenience, et cetera, for commercial item contracts. So it's important to look through your contract, read it, make sure that the clauses in there are the appropriate clauses for your contract. I've run into a number of people who have had clauses or contracts that have been awarded using competitive procedures, and it's a fixed price contract, so it should be exempt from all of these accounting issues. But I've seen companies sign up to these issues even though they don't have to, because they think it's the government is my customer. I want to do the right thing. I want to be a good contractor. And when you do that and you're not supposed to, or you're not required to, it can bring around some pretty interesting issues. So with FAR Part 15, and remember the chart we just showed a couple of slides ago, FAR Part 15 identifies a negotiated contract. There are some compliance obligations, and FAR Part 15 gives you the format and the methodology for proposing costs for a contract that is potentially going to be over $2 million. I've seen prime contractors slow down these requirements to companies who are bidding $20, $30, $50, $900,000 contracts. Those provisions don't necessarily flow down, but many times the primes want you to do that. So if you're doing work with a big prime, then they may tell you that they want you to fill out this schedule and give them the estimate of costs. And if they do, that could lead to some challenges down the road, especially if you're not exactly sure what those things mean. Um, FAR Part 15 does require the submission of cost or pricing data if the contract is over $2 million. And that could be cost or pricing data that needs to be certified, meaning it's current, accurate, and complete in accordance with the Truth in Negotiations Act, also called truthful cost or pricing data. So you've got these requirements in here, and if you fail to follow these requirements, you could get a cost disallowance. You could get a violation of the Truth in Negotiations Act, which is called defective pricing, where they can adjust your contract price downward. And depending on how the government feels and what it may appear to be, the government may say that you made either false statements or false claims, and then you go down a completely different rabbit hole that is not what anybody intended. So dealing with government contracting is a very serious issue. You need to know what you're doing. It's more than just providing a good quality product or a good quality service. It's making sure that you're also in compliance with the requirements of the contract. There are a lot of people who are involved in this. Once you get to the contract that has the need for accounting systems, you're going to meet a whole bunch of people. You're going to meet a procuring contracting officer, which is a PCO. You may meet an administrative contracting officer, which is an ACO. They both take care of different duties. The PCO is with the contract itself, the agency you're contracting to. The ACO is more administrative with business systems and things like that. So we're here to talk about accounting requirements. The PCOs are going to look to their ACO to get insight to make sure that the companies who are bidding do have the requisite systems in place to make sure things work. Then we have a TCO, which is a terminating contracting officer. And this is a person who, in the event of a contract termination, they take over to make sure that the settlement proposals and all the requirements of the 52-249 clauses are taken care of. If you're with the civilian agencies, oftentimes the PCO, ACO, and TCO can be the same person. Within the Department of Defense, the PCO is generally the agency or the service branch that you're dealing with, and the ACO is generally DCMA, or the Defense Contract Management Agency. I put this in the deck because it's important to know that there's a lot of people who are going to be looking at your systems as you move forward. Now, as we talk about contract audits, well, the contract auditor is more of an advisor to the contracting officer. And they're allowed to come in. When you submit a proposal, you've identified that proposal probably has an audit clause at 52.215-2 in there that you say, hey, if you award me this contract, I will open my books and records to the auditor, but it's not an open book. They can't come in and audit everything in most cases. It's going to be based on the type of contract that you have. So if you have a competitive contract or a commercial item contract, there are certain limits as to what sorts of access to books and records the government will have. But if it's a cost reimbursement contract, it's a pretty wide open. Whatever accounting information you have, generally the government auditors are going to be able to access that. There's a lot of judgmental information, a lot of court cases, a lot of exciting things to talk about. We could have a Manhattan one night and talk about what some of those things are, but we just don't have enough time in this session. With civilian agencies, their audit function is oftentimes done by their inspector general. Sometimes they contract it out to a third party, but the idea is to get an experienced person to look at the costs that are being proposed, to look at the costs that are being incurred, to make sure that the government is not paying for unallowable costs or costs that aren't associated with their program. Okay, so the key takeaway for the first session is be prepared, be proactive, know the accounting requirements that you're signing up for, and don't sign up for more than is necessary. So if the contract is going to be competitively bid, don't be signing a certificate of current cost or pricing data. If it's competitively bid, fixed price, don't be signing up for the cost accounting standards. Make sure that you know what you should be signing up for and don't sign up for anything above that. All right. So next, let's talk about the accounting system requirements. Okay. A lot of people think, oh, I just bought, and I can't say the name of a system because there are a bunch out there. There's Deltek, there's Uninet, there's Procast, there's Janus, there's all sorts of software packages out there that people think if I buy this software, then I'm going to get the government auditors and they're going to say, ooh, you're using this software that's great for government contractors. Well, that's not the case. An accounting system is more than just the software itself. The accounting system starts with my cost estimates. So my cost estimates have to comply with the requirements of FAR Table 15-2. And I only need cost estimates for negotiated procurements that are sole source or cost reimbursement type contracts. So if I have commercial item contracts, I'm not going any further in the course. This is only applicable when you have non-competitive fixed price or cost reimbursement type contracts. Okay, it's important that we remember that. So if I have, once I win the contract that is going to be subject to the cost accounting requirements, what do I have to have in my accounting system? Well, the standard form 1408 is called the pre-award survey. And the pre-award survey of accounting systems is basically a listing of about a dozen criteria, a little over a dozen criteria that an accounting system has to have in place in order to be able to account for cost reimbursement type contracts. So, number one, it has to be GAAP compliant and it has to be under general ledger control. So if you're doing a checkbook based business and you want to get into a cost reimbursement contract, that isn't adequate. You have to make sure that you comply with GAAP and that it's under general ledger control. So checkbook business is cash basis. Cash basis is not GAAP. GAAP says you have to be accrual basis. Timekeeping and labor cost distributions are a big element. This is one of the biggest differentiators between a financial accounting system and a accounting system for government contracts. They're both under general ledger control, but you need to be able to track your costs by project, including your labor costs. And the way that you do that is generally through some sort of a timekeeping mechanism. And then that timekeeping mechanism will identify the hours. Then you have to work with your payroll system to figure out how much did I pay the employee for those hours worked so that I can assign the dollars as well as the hours to all of the contracts. So within an acceptable accounting system, we will have project or job cost ledgers where we will take the cost, all my labor cost that's direct to contracts, I'm going to break it up between my different projects. If I have 20 contracts, I'm going to have at least 20 numbers, 20 job numbers for my employees to charge to. If once I assign out all my costs that are direct, I'm going to be left with indirect costs. And my indirect costs, I'm going to have to come up with a pool. How do I want to accumulate these costs so that I can allocate them to the various contracts that they're performing on? And I allocate it based on a base. So fringe benefits, for example, are pooled into a group, and then they oftentimes get allocated out based on direct labor, total salaries. So there may be some fringes going to indirect labor, some will go to direct labor. Then I have overhead costs. That's generally the management and supervision of direct labor. And those costs will be allocated to direct labor. So I may allocate them on direct labor hours, direct labor dollars plus applied fringe. Got a number of different ways that I can do it. But once I set it up for my company, I have to keep it consistent that way. Then I also have to track unallowable costs. So unallowable costs, okay, alcohol, travel in excess of the federal acquisition regulation, the GSA per diem rates that get set, contributions and donations, lobbying, certain legal fees, all have to be treated as unallowable costs, and I can't bill the government for them. Not enough time in this class to go through, but we did have the GovCon 101 accounting systems webinar that went into that in a little bit more detail. An adequate system has to be able to accumulate and report costs by contract. And if my contract has 5 different contract line item numbers or 5 different CLINs, I have to be able to track my costs by each one of those CLINs. So the timekeeping has to be set up, and the material costing, whatever I charge direct, has to be able to be accumulated in the system. And your system has to be able to provide some flexibility because you have GAAP requirements, you have IRS requirements for tax purposes, and there's oftentimes a GAAP to tax difference, and also for government contracting regulations in FAR Part 31 and the CAS, cost accounting standards. There may be differences between what you report on your financials and what you report through government contract accounting as well. And so your system has to be able to provide the flexibility. Sometimes it's taken care of in the system, so you can say take out accruals and you can get a cash base for IRS. Sometimes you can flip a switch and you'll get the accrual accounting that you need to have. So sometimes those controls are built into your accounting system, and sometimes they're external to the system through the use of memorandum entries, external schedules, etc. The use of memorandum records is acceptable under generally accepted accounting principles. It's acceptable under GAAP, and it's also acceptable under government contract requirements. So you can have your GAAP system, and you can use memorandum schedules to account for things to make sure that you can track all of your detailed cost by project, and you don't have to do it in your big system. But if you have significant amounts of government contracts, you don't want to have two different systems. So find a way to pull them together. And a lot of software packages will do that for you. I mean, there are hundreds of software packages out there that can track job costs. Okay, so what is an adequate system? I said before, it's more than just the software. You can see the software is the big white cog here at the bottom. It also involves what are the processes that you use to handle transactions? What are the procedures that you have written down? A government auditor coming in to look at your accounting system is going to look for written procedures. And if you have written procedures, they're going to want to make sure that you're following them. So they're going to test the processes. And they want to make sure that you have adequate internal controls, segregation of duties. Do you have the right types of validations in place? They want to make sure that your people are trained. So you need to be able to show documentation that my people have taken training in these areas. And one of the, it seems benign, but one of the big issues is you have to do this on a timely basis. Some companies I've worked with, they reconcile their books once a year. In the world of government contracting, that's not adequate. So if you are doing all fixed price work and you just need to reconcile your books once a year at tax time, that's fine. But if you have cost reimbursement contracts or sole source contracts that are fixed price, chances are you're going to have to be able to track those costs. And if an auditor comes in and you don't track your costs and make entries on a monthly basis, they will very likely say that your accounting system is not adequate. Now, my takeaway from the accounting systems, our second bullet, is that there are no two systems that are identical. One company versus another, they may do things slightly different. We run into this a lot where company A acquires company B. Well, company B used per diem rates for expenses and company A uses actual expenses. And so all of a sudden you've got two different ways to account for the costs of travel. So the companies have to figure out, how do we want to pull this together? And if the company does use per diems, there are many different ways the companies use per diems. So just looking at somebody else's policies and procedures and copying them and bringing them over and saying we have policies and procedures is not necessarily a safe thing to do. So you want to make sure that your company, your accounting system supports how your management team wants to run the business. You want to design and operate your accounting system to help you achieve your strategic goals. Okay? And so I work with many companies, say, well, Bill, should we do A or B? And I'm like, well, what is your strategy for a company? And if B supports that strategy, then use B, because both A and B can be compliant, but A or B, not A and B. Some companies, oftentimes we see, try to mix the use of per diems with actual cost reimbursement, and they run into some challenges down the road. So it's important for you to figure out what you want to be and how you want to do it, and then you can move forward. Okay, so our second part of today's show deals with accounting systems and what are those requirements. Okay, so now we're going to run through FAR Part 31, the cost principles. I mentioned that the FAR is being updated, but FAR Part 31 has not been one of the updated sections yet. So what we're going to talk about is FAR Part 31 as it currently stands, and we're going to talk a little bit about some other rules that come in place as well if you're not a commercial company. So FAR Part 31, I started out in Part 1 saying, if you have a cost reimbursement contract, if you have a non-competitive contract, chances are you're going to have to worry about the cost principles in FAR Part 31. The clauses we list will bring in the cost principles in FAR Part 31. FAR Part 31, right at the beginning, states, this part contains cost principles and procedures for, quote, the pricing of contracts, subcontracts, and modification to contracts and subcontracts whenever cost analysis is performed. So if the government has to do cost analysis, they can't determine your price is fair and reasonable on price alone. They have to do cost analysis. And the contracting officer will tell you, I need cost. Once they do that, FAR Part 31 is going to be applicable to your contract, and the need for an accounting system, the need for demonstrating that you can comply with these requirements comes into play. The second part of FAR Part 31 states the determination, negotiation, or allowance of a cost whenever required by a contract clause. So all those contract clauses I listed and dozens more are the ones that will tell you if you have a need to have an accounting system that's acceptable. So with the cost principles that are contained in FAR Part 31, there are some compliance obligations. Number one, there's a criteria that's built into the cost principles on how you have to allocate costs. So what you decide to charge direct, what you decide to charge indirect. Company A can choose to charge this cost direct. Company B might put it indirect. There's nothing wrong with that. This part also defines what costs are allowable and what costs are not allowable. So FAR Part 31 will state that interest expense is unallowable, bad debt expense is unallowable. I'm going to show you two slides here. You've got the slides available to you, so I'm not going to worry about that. But FAR Part 31 also requires that if you have costs that are unallowable, you have to exclude them from any allocations to a cost to a contract where the cost principles in FAR Part 31 apply. So if you have a fixed price contract competitively bid and you have an annual holiday party with alcohol and that's in your G&A rate, okay, well, nobody cares because that G&A rate is not going to be used on your contract. Your contract price is determined by competitive procedures. Your contract price is determined by commercial prices in the marketplace. Once you have to go to cost, and if the contracting officer says, oh, I really need a little bit more insight here, I'm going to do some cost analysis. If you can't push back successfully on that, then the cost principles from FAR Part 31 will apply. And it's important because there are penalties if you ignore this requirement. If the requirement is in your contract and you can't push it away, then if you have costs that are unallowable, but you include them in an overhead rate or a G&A rate, or you charged it as an other direct cost to your customer, they can choose to disallow that portion that's unallowable. If they think that you should have known better, but you did it anyway, they can put a penalty on top of that. So if you bill $10,000 of travel that's unallowable, and the customer says, oh, you should have known better than that, not only do you have to pay us back the $10,000 that we may have paid you for, but we're also going to put a penalty equal to $10,000 on top of that. So you'll have double damages. And if the government paid it earlier and the audit found it later, they can collect interest on the amount of the overpayment as long as you had the government's money. And there are also penalties if the government thinks that it was intentional. They can pursue false claims and other sorts of things. So FAR Part 31 is all about cost principles. For those contracts where cost principles are applicable, FAR Part 31 says that cost is the sum of four things. It's your direct costs, direct labor, materials, etc., plus your indirect costs, overhead, G&A, fringe benefits, plus cost of money. So cost of money is it's a non-cost cost. It's built into the cost accounting standards is how it's calculated. If you're a service contractor, you're probably not spending a lot of time looking at cost of money. But if you're a fixed price, if you're a manufacturer, you probably have a lot of plant, property, and equipment. So the more assets that you have on your balance sheet, the more likely you should be considering the use of cost of money if you're in the cost reimbursement contract, if you're in the cost justified contract world. And then finally, credits. Some people got PPP loans during COVID, and there was a lot of questions that came up and said, well, that was free money from the government, and you got that as a credit. Well, you billed us for some labor costs that the government credited through the PPP loan process. So there may have been some credits that come into play there. If you get rebates from a vendor, say, "Ooh, we're going to use Joe Smith because he gives us a rebate." Or if you use some of the common apps that are upside, for example, okay, I'm going to buy something and I'm going to get a 10% rebate. If I get a 10% rebate, I have to pass that back to my customer if my contract is cost reimbursement or if my contract is going to be subject to the FAR cost principles. Okay. Within the FAR cost principles, it talks about direct and indirect costs. Direct costs are those costs that can be identified to one and only one contract. Now, if I have some costs that are direct costs, but they're relatively insignificant, I had to mail a letter to the contracting officer and I had to put, I don't know what postage is today because I use forever stamp, 72 cents, 85 cents, whatever the number is. Clearly, that benefited only that contract. But at the end of the day, it's probably going to cost me more to try to track that 85 cents than it is for me not to. So if it's an insignificant direct cost, it can be allocated through overhead. It's not a big deal. Indirect costs, as I mentioned before, these are costs that can't be assigned directly to a contract. Oftentimes it's management and supervision, but it's everything that's left over once I pull and assign all my direct costs. Includes things like overhead. You may have heard of overhead. You may have heard general and administrative expenses. Those are pools of costs that are associated with cost reimbursement contracts or fixed price contracts where you don't have competition and you had to provide a cost estimate. With this, there's a lot of guidance that's in play that identifies how the types of things you should consider when you set up those allocation bases. Once you make that determination, your accounting system has to be able to track that. Okay, so is a cost allowable? One of my favorite things. I get this question asked almost every day. I had it this morning already, so I can check it off for today. Is, hey, Bill, is this cost allowable? Well, to determine if a cost is allowable, it's a 5-part test. A lot of people think, I don't think that the government's going to pay for that, so we'll mark it as unallowable. I don't do that. I go through this 5-part test. It's written right into FAR Part 31. So, is a cost allowable? Okay. Is it reasonable? There's a prudent person test. Would a prudent person in the conduct of a competitive business incur this cost? If they would, then it's reasonable. Next is allocable. If it's allocable as a direct cost or as an overhead cost or as a G&A cost, then it's allocable. Okay. The next is the standards of the Cost Accounting Standards Board or generally accepted accounting practices, GAAP. So if you're allocating costs in accordance with GAAP or CAS, okay, then it may be allowable. The next is the terms of the contract. I may have a cost that's very ordinary and necessary. So I pay my people for personal use of their automobile. It's reasonable. It fits prudent people, prudent persons in the conduct of competitive business would pay people based on the IRS rate. Allocable, well, if they're driving directly for a contract, it's assignable to that contract. They had to drive out to pick up some parts to come back to put them in, and I paid them POV mileage. Definitely reasonable, definitely allocable. It's only benefiting that contract. Nothing in CAS or GAAP say that's wrong. But I may have a contract term that says, hey, we will not reimburse you for any POV mileage within 50 miles of the base. So you may pay your employee because it's the right thing to do, but the government may have a clause in your contract that says, but we're not going to reimburse you because it was within 50 miles of the base. And then finally, there's a whole bunch of cost principles that are out there. We're going to scan through those very quickly here in just a minute. But in general, most business costs are allowable. There are some that are expressly unallowable and some that have limitations. So if you're going to get into government contracting, it's important, and you're going to get into the area where cost becomes an issue, it's going to be very important for you to understand cost allowability. You as a contractor have to maintain adequate accounting records, and you have to allocate costs on a consistent basis. Okay? And there are oftentimes a lot of challenges that auditors come in, at least 2, 3, 4 times a week. I will get questions from clients saying, hey, DCA was just in doing this review of my incurred cost proposal from last year, something you have to do if you have cost reimbursement contracts. And they're asking questions about this bonus payment. They're asking questions about this disbursement. They're asking questions about this. And when they do, we have to go through the 5-part test. So the 5th part is cost principle limitations. So I have 2 pages of these. We're not going to go through any of these in general. If you do have questions on one of these, feel free to save it for the last 10 minutes. I'll be happy to answer the question to the best of my ability. But when you take a look at these are costs that are identified. So public relations and advertising costs is the cost principle number 1. So 31205-1, it's the first one on the list. And when you look at it, it says that the cost of advertising is unallowable unless it's help wanted advertising. And there's certain caveats with that. Bad debt expense, expressly unallowable. The government says, why should we pay bad debt expense for your deadbeat customers when we pay our bills all the time? Depreciation costs are generally allowable, but you have to go through and understand what sort of curbs they put in the road with them. Lobbying and political activity costs are expressly unallowable costs. So if you have somebody out there trying to woo a congressman or a colonel or a general or an admiral to award a contract and bend it your way, that's lobbying. And those costs are unallowable. There's a cost principle in here on material costs. Well, material costs are generally allowable, but you have to use some consistency when you do those. The rest of the clauses here, they're actually listed 31205-1 through 31205-52. There's about 5 or 6 that have been reserved. So we've got about 45, 46 cost principles, and each one of these will identify what is allowable and what's not allowable. So for taxes, for example, the top of the right column, the taxes cost principle says, hey, most taxes are allowable costs. You have to pay them because you're in a commercial business. However, federal income taxes are not an allowable cost. Excise taxes are not allowable costs. So there are certain taxes that are unallowable, certain taxes that are allowable. State income taxes are allowable costs, but there's a lot of court cases and a lot of interpretations on this because of subchapter S corporations. If you're a flow-through entity, generally the taxes are not the liability of the company, the taxes are the liability of the owner of the company. So even with taxes, not only do you have to understand the federal acquisition regulation, but you may have to understand some court decisions that are out there as well. So a lot of different elements associated with cost allowability. The penalties I've already talked about. In here, if you bill the government for a cost that's unallowable on a cost plus contract, or if you include unallowable costs in your cost estimate, that is the basis for your price because it wasn't competitive, or the government said, hey, give me an estimate, chances are, if you have unallowable costs, you will at least be giving that money back to the government, but they may come back for penalties and interest. There are a lot of challenges because the auditors expect to see certain levels of documentation. Within an expense report, the auditor expects to see an approval. Did the employee get the approval to go on this trip? They want to see that documentation. If the documentation doesn't exist, DCA will oftentimes raise their hand and say, oh, I can't confirm that you met the requirements of the cost principles, so therefore I can't express an opinion, or the cost principle says it has to be in documentation, and I didn't find it. So oftentimes DCA may question costs. The auditor has access to both the budgets as well as the incurred cost, and they will look for differences. And if they see a difference, they may raise questions. Also, there's a lot of balance of power going back and forth between the various overseers, these ACOs, the PCOs, and the auditors. And generally, contractors are going to be smack dab in the middle. At the end of the day, you may have costs that are allowable that you think you're entitled to recover from your customer. And if it's not in the budget, if they don't have enough money, they may push back. Because at the end of the day, depending on your contract type and your terms and conditions, you may be able to get costs recovered. You may not be able to. Okay, so let's take the key takeaway from the FAR. Cost allowability is most of the time pretty straightforward, but there are a lot of nuances, and some of those nuances may make you want to reach out to your corporate counsel, to your outside counsel, to other resources that your firm may have. And like I said, I do get calls pretty much on a daily basis with regard to cost allowability and interpretations of FAR Part 31. So I've been doing it for 40 years, and I see something new every week that's coming in, and I see other things that are coming in that we've had to deal with many times over. So it's always exciting when we see something new. All right. Well, let's finish up today's discussion. We're going to talk about the cost accounting standards. We're going to go till about 5 past the hour. And then with that, we're going to go through some review questions. So if you're thinking of questions, if you've got something noodling around in your mind, now's the time to go to the question panel and start to put those questions into the question box. And I'll try to answer as many of them as I can before we sign off for today. All right, so our fourth bullet on the list of things we want to talk about today is the cost accounting standards. Okay? And since we've got 10 minutes to talk about the cost accounting standards, we do a cost accounting standards session for Public Contracting Institute, and I think it's 12 1.5-hour sessions. We also do a 2 8-hour day session class. So there's a lot that goes into the cost accounting standards. Okay, so let's talk about the cost accounting standards in a minute. And so with this, CAS is a 3-part test. Okay, first, it's important to understand that a company is not subject to the cost accounting standards, but they may be performing on a contract that is. So if you get 10 contracts awarded this year, and you have to look at each one separately. So if a contract is awarded and it's not subject, or I'm sorry, if it has an exemption to the cost accounting standards, it will not be subject to CAS. Not today, not ever. So contract has to be determined to be subject to CAS. Next, you have to determine if it's full or modified, and then you have to determine if a disclosure statement is required. Those are the 3 steps for CAS. The first step is very easy. There are 9 exemptions that are listed in the cost accounting standards. 9. You'll see they're numbered 1 to 15, but 6 of them have been eliminated. They're now reserved. So there are 9 exemptions to the cost accounting standards. If any one of these exemptions applies, your contract is exempt from CAS. Don't sign up for a CAS covered contract if it's exempt from CAS. The second is, if it's going to be over $50 million, it's going to be subject to full CAS covered. If it's less than $50 million, it may be subject to modified CAS coverage. And the difference between full and modified is for full CAS coverage, you deal with all 19 of the cost accounting standards. For modified CAS, you only deal with 4, the 4 basic standards. Some people think, oh, well, we'll ease our way into CAS. We'll do modified CAS first, and then we'll get to full CAS later. And I say, don't get misguided. If you're going to get a contract that's subject to CAS, you're going to have the onus of reporting. You're going to have the onus of compliance. You're going to have the onus of, if I want to change my cost accounting practices, I'm going to have to do a mother may I to let the government know that I'm changing my cost accounting practices. So modified is not a lot easier than full. It's a little bit easier because I have fewer standards, but the administrative pain in the patootie is the same. And then finally, we have a disclosure statement. And a disclosure statement, if you're subject to full CAS coverage, you have to put together this document that lists all my cost accounting practices. And we'll talk about that here in just a minute. So let's talk about some of the exemptions here. So there are 9 exemptions. If it's a sealed bid contract in accordance with Part 14 of the FAR, it's exempt from CAS. You saw in that chart that I said if it's FAR Part 14 sealed bid, it's competition. Done. Competitive contracts are exempt from the cost accounting standards if they're competitive fixed price. Little caveat we'll talk about here in a minute. The next is negotiated contracts and subcontracts in excess of the TINA threshold, which is currently $2 million. There is, if you take a look at the minutes to the CAS board, they are looking at the possibility of disconnecting CAS from TINA. Currently, they're connected through this $2 million threshold. But the Cost Accounting Standards Board is saying, if we get rid of that, if we get rid of the $2 million threshold, if we disconnect the two, and we put the threshold at $10 million, we'll have fewer contract awards subject to CAS but we'll still have the big risk contractors and their contracts subject to the requirements of the cost accounting standards. So the CAS board is trying to find ways to make it simpler. There was a Section 809 panel for the Department of Defense a couple of years ago, well, a decade ago, that identified that there is a burden associated with compliance with the CAS, and it's hindering competition from entering into the Department of Defense marketplace. So they're considering increasing the threshold. It hasn't been increased yet, but it's something that they are considering, and it's in the minutes to their meetings. Contracts with small businesses are exempt from CAS if the price is set by law or regulation, exempt from CAS. If it's a firm fixed price contract for the acquisition of commercial items, even if it includes an economic price adjustment clause, it will be exempt from CAS. If it's a firm fixed price contract where you had adequate price competition and certified cost of pricing data is not required, it's exempt from CAS. Okay. Notice there's nothing in here about cost reimbursement contracts. So if I'm a large business getting a cost reimbursement contract greater than $2 million, chances are it's going to be subject to CAS. But if I'm a small business being awarded a $1 billion contract, it'll be exempt from CAS, even if it's cost plus, because of that third bullet exemption. The other three exemptions, I told you there were a total of 9. The trigger contract of $7.5 million. Forget about the $2 million at first. Once you get your first $7.5 million contract, that's the trigger contract, and that's going to be subject to CAS if none of the other exemptions apply. And then after that, the threshold drops to $2 million. The CAS board is currently saying, hey, if we put that threshold up to $10 million, we can get rid of this trigger contract. Probably one of the most confusing exemptions that's there. One of my favorites, subcontracts under the NATO Patrol Quadrifoil Missile Ship Program are exempt from CAS. I haven't seen anybody working on the PHM ship program. There's some pictures on the internet that you can find, but it's still an exemption. Probably one of the ones that should go. We'll soon be to 8. And lastly, if you're dealing with a foreign government or a foreign enterprise, if their contract has no other exemptions, they will be subject only to Cost Accounting Standard 401 and 402, which are the consistency standards. The CAS board does provide for some waivers. We haven't seen a lot of those lately. If companies and contracting officers want to avoid CAS coverage, they will generally use other transaction agreements or something different that's available to them. But if it's going to be a contract awarded under the FAR requirements, if none of those exemptions apply, if the company doesn't want to comply with FAR, they can go and try to get a waiver of the requirements. And there's a process in place to try to get that done. There are 7 clauses for the CAS. This is the 52-230 clauses. And so, Cynthia, you asked a question, what clauses did you say not to sign up for if you bid a competitive bid? So if you have a fixed price competitive bid, these are some of the clauses that you don't want to have. These are the CAS clauses. So make sure that these are not in your contract if any of the exemption applies. If you're a small business, make sure none of these clauses are in your subcontract with your prime. And make sure that chances are most of the time the government will not include these if there's a CAS exemption, but we've seen a lot of challenges with primes, the bigs, as they try to go through this. The standards themselves, they're really kind of common sense. In fact, the CAS board, another activity they're doing is they're looking at eliminating CAS 404 and 409, depreciation and capitalization, because they're saying this is covered in GAAP. They're looking at getting rid of Cost Accounting Standard 408, which is accounting for compensated personal absences, once again, because Cost Accounting Standard 408 is kind of in play. They're also looking at getting rid of Cost Accounting Standard 411, accounting for material costs. Most of the standard deals with inventory valuation methods. When these standards were issued back in the 1960s and 70s, well, 1970s, there was not a lot of GAAP guidance. Over the years, we've got more GAAP guidance in each of these areas, and the two, GAAP as well as CAS, align pretty closely. So the CAS board has issued documentation through the Federal Register proposing to get rid of it, trying to get feedback from industry. And so we may not have those standards by the end of the year, those 4. We'll still have the others. The disclosure statement is simply a document that identifies a little bit about the company in Part 1. a description of what costs have you chosen to charge direct in part 2. Part 3 is how do you decide whether a cost is direct or indirect? What process do you use? What thought process? Part 4 describes all your overhead and G&A pools, and if you have service centers, how they're identified. And then part 5 is depreciation and capitalization. Part 6 is miscellaneous other costs and credits. Part 7 deals with a lot of the HR type expenses that you may see or costs you may see in your fringe benefit pool if you have one. And then part 8 deals with home office expenses. If you are getting into these types of contracts and any of these things ring a bell, you may want to get a little bit of help by somebody who has an understanding of what these things are to make sure you're not stepping into, as Admiral Akbar would say, a trap. All right. Cost accounting standards. With the other ones, we kind of talked about compliance obligations. And here with the CAS, there's no shortage. When you sign up to the CAS, this is an administrative obligation. You know, the FAR cost principles, you're signing up for them and they go through. With the cost accounting standards, it's very deliberate. You have a disclosure statement, you have the clauses, you have all of these things. And if you want to change how you allocate costs under the cost accounting standards, then you have to go through a very deliberative process to make adjustments to contract prices that are contracts subject to CAS. With the FAR, you don't have that. If you have a contract subject to CAS, that deliberative process, that mother may I comes in for contract price adjustments. If your allocations are going to allocate more cost to government contracts, you will not get a price increase on those contracts. And then once again, we get to deal with the statute of limitations. I'm sorry, with the interest penalties. Okay, last slide of the day before we get into our 4 questions. And I've only seen Cynthia's question come in, so I must have done a great job of explaining everything since nobody has any questions. But some of the current activities of the CAS board, I kind of already talked about these. CAS and GAAP, conforming the two. And if it's already in GAAP, they're going to get rid of it in CAS. One of the things they're looking at is the applicability of CAS to an indefinite delivery, indefinite quantity contract. The CAS board calls them IDVs, indefinite delivery vehicles. But that's been a question for the past 2 decades. A lot of us who've been doing government contracting for a while like to sit around with a nice cold Manhattan and talk about, okay, is an IDIQ contract subject to CAS or not? And we have a lot of fun discussions. But the CAS board is trying to take that fun away from us by coming up with a definitive answer. The cost impact process, currently there's a big court case with Boeing, there's some DCA guidance out there, and the CAS board is looking at that to say, hey, you've got the CAS, you've got FAR Part 30, there's some guidance in there that's not quite the right thing. We as the CAS board should be addressing this. So they're trying to address that. The threshold, they're saying, hey, we're going to increase that to 10 million, get rid of the trigger contract. And then one of the other things they're looking at is possibly moving full CAS coverage up to $100 million from 50 million. So lots of things being concerned. If CAS is an issue to you, you may want to Google cost accounting standards and 809 panel recommendations. A lot of that is being considered by the CAS board today. All right, so with that, Josh, are you ready to close out the day and go through our 4 polling questions here?
Sure am. Polling question number 1. Before I jump in, just make sure you guys are clicking on our. If you're unable to submit your response, send it through the questions panel. Polling question number 1. When is an accounting system needed for government contracting? A, for all federal prime contracts. B, for commercial service contracts. C, for competitive contracts. Or D, for cost contracts.
Okay, so this was the first session that we discussed. I don't see the poll up there yet. There it is. Okay, so I can see everybody's answers when they come in. Okay, so the question here is, when is an accounting system needed for government contracting? Okay, and my first section was saying it's not needed for all. So those of you that picked A, remember, it's not for all government contracts. And for those of you that have picked B or C, remember we said those were the green check mark, the green X's on the chart. Those were the ones that you want to try to go for commercial services or for competitive contracts if you don't have a system that you think is acceptable for government contract purposes. It may meet all the gap requirements. Okay, so as we go through here, of course, the answer to the first one is D. Cost reimbursement contracts are the only types of contracts where it's mandated in FAR Part 16 that says you want to get a cost reimbursement contract, you have to have a system that will track and accumulate the costs associated with that contract. Okay, thank you. Let's go on to polling question number 2. This deals with the second group that we talked about today.
I'll read that out loud. What is an accounting system? Let me go ahead and put that up before I read the options. A, the software. B, the policies and procedures. C, the internal controls. D, training. Or E, all of the above.
Okay, and I'm loving all of the questions that are coming in because almost every single one of you has answered E. Okay, and as I said when we talked about the accounting system, remember my very pretty graphic that I put up there? The software is a piece of it. Your policies and procedures are a piece of the accounting system. The internal controls are a piece of the accounting system. Training for the people who are touching and using the system is a piece of the accounting system. So all of the above is the correct answer for what is an accounting system. It's not simply going out and buying Deltek or Uninet or JAMIS or Procast or any other software package that sells that they cater and address government contract accounting requirements. Okay, so thank you. This was an awesome slide. Almost everybody selected E. Okay, polling question number 3, Joshua.
Which of the following is not a criteria for a cost to be allowable?
Take your time and read this question. I know that word problems oftentimes are concerning, but read each one. And not is in big letters. Okay, Josh, it's all yours.
Thanks, but I'm going to go ahead and put that up.
And I see we're getting a lot of people coming in and considering 2 here. So which of the following is not a criteria for a cost to be allowable? Well, we know it's a 5-part test. So reasonable and allocable are 2 of the tests that it has to pass. So it cannot be A or B. And if we take a look at D, the cost is not unallowable per an applicable cost principle. Well, that was the 5th test. So we have the 1st, the 2nd, and the 5th test in A, B, and D. So by the process of elimination, Inspector Poirot or Miss Marple or whoever your favorite detective is, oftentimes mine is Perry Mason, but we'll cover that a different day. The cost does not have to be approved by DCAA or DCMA. Okay, so that was the one that was not included in there. The 2 that we did not include out of the 5-part test were contract terms and conditions make it unallowable, or gap or CAS makes it so that it's not in accordance with the rules. Okay, so everybody that picked C, and most of you picked C, thank you. Excellent. Okay, so now for our last polling question. Thank you, Ashley. I forgot all about Inspector Clouseau. And how could I forget that? Okay, so now for our final polling question, number 4.
Which of the following contracts would not be exempt from CAS? Give you guys a moment to read those options.
Oh, take your time. Don't answer too quickly. This is not a trick question. Okay, but you may remember we talked about those types of contracts that don't require accounting, that don't have the need for accounting. So a contract for commercial services would be one of those. So most of you can eliminate number one because that's not a contract that would be. I'm sorry, which of the following contracts would not be? Yeah, my double negative in there was confusing even me. Okay, so the first one would be exempt from CAS. Okay. And if we take a look at the other ones, okay, if I have a $25 million competitive contract, competition is one of our exemptions as well, where the contracting officer asked for uncertified cost or pricing data. Okay, so if they ask for certified cost or pricing data, the exemption goes away and you have to look at one of the other 8. So number 2 doesn't fit the bill either. Okay, and then let's take a look at number 4. Hopefully nobody picked number 4. Well, a few of you did, because a contract awarded to a small business is automatically exempt from the cost accounting standards as well. So that leaves us with number C or E. And remember, cost reimbursement contracts, they bring everything in. So if it's a large business that received a cost reimbursement contract, over the trigger, that contract will be subject to the requirements of CAS. So the answer for this is C. Okay, so with that, I'm finished. I don't have any more questions that have come in. Josh, do you have one last polling question for everybody to see how we did today?
I sure do.
Oh, how
Thanks,
cool.
Bill. As always, we'd love to know how we did. All feedback is greatly appreciated. If you have any questions, feel free to send them through. We're more than happy to follow up. If not, I wish everyone a wonderful afternoon. Make sure you visit our website for our upcoming programs. We have a lot of great stuff, and we hope to have you all again. Thanks, Bill. I wish you all a wonderful afternoon.
Thank you, Josh. Thank you, everybody.